All right, so let's get into the presentation here on the basics, and I'm going to ask for a little interaction from you all. If you wouldn't mind, maybe just type it in some answers here for me. Let's just hear it from you on the webinar today. What is a stock? Who's willing to throw out an idea there? Good. So I see, ownership. Somebody said, own a piece of a company, right? So you own a share of an organization or an entity. So you see some of the stock certificates of some pretty well-recognized companies out there. And so if I own one share of Apple Computer, then I am one gazillionth owner of Apple Computer. So if Apple comes out with new innovation and new technology or a new product and the share price goes up, then my investment in Apple goes up. And the money that I put in, is increased, obviously. If the executive team leaves, or if something happens with a negative light on it within Apple Computer and the share price goes down, then obviously my account goes down. The question that I've been receiving more and more lately from folks, especially with some of this more recent turmoil and downturn and volatility that we've been seeing in the market, is can I lose everything inside of my 401k? And let me just pose that question to you all. Who thinks that yes, you could your 401k or your 403b could go to zero? Okay, I see some different responses there. And the answer is yes. Technically, your 401k account could go down to zero, but really we need to understand how would that happen. And we're going to get into this in a little bit more detail when we talk about mutual funds. But, for many of you who are investing inside of your company-sponsored retirement plan, you are investing in, probably somewhere in the neighborhood of the top 5,000 to 10,000 companies around the world. Some of the biggest companies, the most widely recognized names, products that you buy day in and day out are produced and developed by these companies. And so the reality is, if all 10,000 of those companies simultaneously was to go out of business, then yes, your 401k, your retirement account would go to zero. And I think the reality is, if that did occur, and Coca-Cola and Kraft and Apple and IBM and Exxon and all these different major companies around the world went out of business, the 401k would probably be the one of the last things we'd be thinking about, right? If that happened, we'd really be thinking about, like, how do I make fire? And how do I milk a cow? And how do I, life would change pretty dramatically if that was to occur. But with that said, the reality is that companies do go out of business. And depending on how much of our, investment is in those companies, we can see a loss in our account, not just to mention the fact that, again, companies can go down in value based upon market pressures, as well as just different internal things going on with that organization. As you see the list here, the 4 stock certificates that we put up, does any one of those 4 jump out at you or feel like those are all pretty good companies? Okay, so I see a couple of you already responding pretty quickly there. Right, we put Blockbuster up there on purpose because companies do go out of business. What happened to Blockbuster? Who can write in for me? What occurred there? Right, bankruptcy. Somebody wrote Netflix. Innovation occurred, and Blockbuster couldn't keep up, and Blockbuster had to declare bankruptcy. And so in the case of owning a share of Blockbuster's stock, when Blockbuster declared bankruptcy, the value of my share was zero. So the money that I had invested in Blockbuster went to zero, and I lost that investment. And so that occurs in the marketplace. And we've got to make sure that we're aware of, the companies that we're investing in. And, there's different ways that we're doing that. I think a lot of you are investing in many companies that, probably you're not even fully aware of. As, you have to look into the prospectus and look under the hood of some of the different mutual funds that you're putting your money into and the target date funds that you're putting your money into and how they're spreading that money out into those, as I mentioned, those 10,000 or so companies around the world. Let's touch on the other side of the coin, a little bit safer side of the coin, which is a bond. What's a bond? Who can kind of write in for me? Okay, so not as quick to write in here. So somebody wrote an IOU. Interesting, good. And that's a good way to think about it. Really, it's a matter of you lending money to either a government or a corporation to purchase their bond. And what that means when you're purchasing their bond is that you're giving them some amount of money. Typically, bonds are purchased in $1,000 increments. But if I'm going to buy a bond from GE, I'm basically, and let's call it a 5-year bond. GE is saying to me, okay, we're going to pay you a certain amount of yield or interest on that bond that you've purchased. Let's call it 3%. And so for your $1,000 investment into our company, we're going to pay you $30 a year for the next 5 years. And then at the end of 5 years, we're going to pay you back that $1,000 investment. So again, the opportunity for growth inside of bonds is typically lower, and we'll see some of those when we get into the historical performance, than stocks. But also the risk that's associated with investing in bonds of a company or bonds of a nation, U.S. bonds or other countries, is lower. And the reason for that is if we go back to the case of, and Blockbuster's probably not a great example there, but let's use GE as an example here for a second. If GE was to go out of business and we own the stock, we have nothing. But if GE goes out of business and we own a bond from GE, then we actually are going to get a little bit more than nothing. And so what's going to happen there in real life is that they're going to just line up the different creditors. And so GE will then pay out those creditors in the bankruptcy proceedings, depending on how that is dictated by the court system. And so typically employees are going to be paid out first, what's owed to them, and then bondholders, and then you kind of work down the line of other creditors that are owed by the organization that's declared bankruptcy.